So I saw you backstage listening intently to Governor Biles and what he had to say about interest rates and policy decisions and all of this stuff. So now that you've heard his explanations, how will this impact? In fact, before I ask you how it impacts investors, what do you make of the explanations?
Well, yes, he's quite correct. There are several other external influences on our domestic economy. For example, I'm looking at some data that are published every day, quite often weekly in both newspapers published by Statin, PIOJ, and the BOJ. And we're looking at the gross domestic product and our exports, inflation in various sectors, and growth in various economic sectors. We're also looking at some figures that shows the international merchandise trade, and of course the probable impact that anything in one of these economies can have on us. For example, in the US, for our top 5 importing countries, the US makes up about 65% of that value. For our top 5 exporting countries we export to, the US makes up in terms of export value about in excess of 52% of that. So any policies, decision made by the Trump administration or any other government in the US, any particular hiccup in terms of any major industry in the US or the broader economy in the US can impact us. You see? Of course, we talk about remittance. I just heard today that the BPO sector is one of the 3rd or 4th, at least in the top 5 FX earning sector. Anything that happens in any of these industries or the broader economy of the US can impact us.
Yeah, so BPO is huge.
Exactly. So if we know that the tariffs added to cost in the US. We know that in the early part of the year, there's a massive importation of raw material and goods. So the GDP seemed to have grown. That was a temporary thing in the US. The big thought now is that that tariff and added cost will now are now being transferred to consumers. So we see it in the US. So even though rates were lowered, the Fed rate just recently, there is the thought that they're still awaiting and looking carefully at how the cost structure is going to impact inflation in the US. If that happens, where will the Fed rate go? And if that happens again, the impact it will have on us. What we are trying to resist is capital flight. As well as, of course, imported
Stick up in there, Clive. Let me ask you to refresh your browser. And while you do that, hopefully you come up. While you do that, I'm going to take some more comments from the audience.
Yes.
So, yeah, let's see if we can get Clive's visual back up. All right. So who else do we have here? Rob said, unless we remove asset taxes, it's going to be difficult to lower interest rates. Orville says, we need a level playing field. The Diplomat said, here's an interesting point. So if banks don't ever feel the need to lower interest rates, that's it. You can't make this up. Jovan says, very concerning that the central bank can't dictate a cap for interest rates for commercial banks. Where is the protection for consumers? Profits is all commercial banks care about. We have Clive back. I'm still not seeing his video. Still not seeing you, Clive. Can we hear you now? Clive, can you say something for me?
Yes. Are you able to hear me?
I can hear you again.
Okay, great.
All right. So let's pick up where you left off. I guess we just have to work with audio only for today.
Okay, sorry about that. I mean, from my perspective, I'm seeing myself, so I thought you were seeing me also. Yes. So as I've said before, is that the BOJ governor is quite correct that much of our costs were fairly tied to the US economy in some way, fashion, or form. And any impact, any adjustment to the economy, our policies can have some impact on us. So we still have to take a cautionary stance with respect to interest rate. But I think, however, that there is a level of optimism, in our economy. One, over the last several years, there's a shift of how capital is raised. Just looking at the listed entities, many of them, there's a flurry of capital raising via the equity market between 2014 and, let's say, 2020 to 2021. That kind of eased a little bit during the COVID period. We saw a little bit of uptick in 2022 to 23. But what we saw there was companies raising capital via debt. Of course, interest rate, there's an interest cost to that, and that went up significantly. What we have seen just recently since here is that quite a few of those companies are refinancing those debts. Several of them have now come back to the market, to the people that have issued these debt secured, and we're talking tens of millions of US and billions of Jamaican dollars, and asking them to extend tenor as well as to lower the coupon interest. We have seen at least one company that is a private entity, not listed, that raised a couple billions of dollars that asked for an extension in tenor and a lower of interest rate by in excess of 100 basis point. And we have also seen 1 percentage point, I should say, right? And then we have also seen just recently at least one public entity so far that has come to the market to extend, asking them, and the market has agreed, their issue, the bondholders have agreed to extend tenor as well as to lower coupon interest rate. And I think what it signifies to me is that the market broadly is preparing for lower interest rate. Maybe not now in this quarter, in the next calendar quarter, January to March, but certainly in the near future, perhaps 2026, 2027. And that augurs well for the broader economy. I think there's a level of confidence, stable confidence, or perhaps growing confidence in the marketplace now.
You know, on that point, in the next couple of years, 2027, Clive, is when we're expected to hit our debt to GDP target and be right around 60%. And at that point, I anticipate that the credit ratings agencies are going to bump us up probably to investment grade. Right now, we're just 2 notches below. We're at double B minus, I think it was.
Yes,
double
I think
B,
so, yeah.
double B.
Yeah.
We're at double B on Standard and Poor's. So next above that is double B plus. And after double B plus, we enter the triple B range, which is investment grade. So we're right on the cusp. And I think that when we get to that, when we hit that debt to GDP target in 2 years, possibly even a little bit sooner, we're going to get bumped up. And that is going to open us up to lower interest rates from the international capital markets.
Well, interestingly, we have had 2 favorable upgrades just recently. I think Fitch and Standard and Poor's so far. And that does also, it also upgrades our senior issued notes and papers, because I think at least 2 other or 3 major issuers were also upgraded. When the country is upgraded, then potentially issuers are upgraded also, which means that they can now borrow money on the international market at lower cost, you see. So that look is good for us. Of course, there are quite a number of criteria. There's sustainability. You know, that the GDP ratio might be adjusted positively, but is it sustainable? What is happening in the sphere that influences our economy regionally, as well as globally? And it's not just economic, it's political also. You know, hopefully in the Latin America region, there's peace, there's stability, you know, because all of those can impact in any way, direction, our prospect. So I would hope that there's some maintenance of stability. But where domestic economy is concerned, yes. And so far, I think we're on the right footing. And that can translate to value on the stock market also. It should.
How so? How would that translate to value on the stock market?
Well, lower interest rates, as you know, indicated by the governor. There are some preconditions. Yes, those preconditions are inflation, stable inflation and lower inflation. That means then that businesses can plan. It means also businesses can borrow at lower cost, whether it's equity capital, whether it's debt capital. You know, companies can borrow at lower cost. It means that valuation of companies through generating revenue, through the build out of profit, through the acquisition of capital, land, building, all of those can be done at a cheaper cost and spur the generation of capital, of profit. And that is what will drive the price of the securities on the market.
So how big of a deal is it when we get these ratings upgrades, Clive? Because to the ordinary person, it probably seems like just something aloof up in the sky.
Yes, it is significant. The government can issue securities in the international market at lower rate. It means like our major corporation, for example, the Airport Authority, the 2 bonds that they were just issued were upgraded. There is another company whose bond issue was also upgraded. It means that those companies can then go to the international market and even the domestic market and seek lower rates. So it does well for them. And the capital raise here is not 100 million, half a billion Jamaican dollars. These are usually in the multi-millions of US dollars. So it looks good for them. And it means that there's a level of stability and sustainability of revenue, to pay off these debt. So it augurs well, it means well. And all of that down the line will translate to efficiency, employment, reduce prices, which is reduce inflation, more goods and services available, hopefully export, which can contribute to our FX rate. It translates to a whole plethora of various happenings, and that again translate back to value on the stock market.
Well, we are definitely looking forward to the day when we see the stock market prices doing a lot better than they are today. So
yes,
2 to 3 years, your outlook?
Interestingly, COVID came, and we thought it was a little bit temporary. It lasted a little bit longer. Many analysts right across the board, including here, have been expounding that look carefully at financials, good strong balance sheet, good cash flow, especially what we call operating cash flow. That is cash you derive flow from your operating activity, revenue generating activity. Look at that. Look, of course, at the sensible management of companies. That is critical and important. But what we'd like to say also is that every now and then something new happens. We know the Ukraine-Russian war, then we found out that at that time, many persons found out how important these two economies were to global commodity prices. Right? We know that in the Middle East, at one point, just recently, a few months ago, the fear of a war breaking out, what that would have done to energy prices. Now, of course, we have another potential situation right on our doorstep here. What that can do to the destabilization of a particular region. These are things that anytime seemingly pops up. Of course, there's always a center, a complicit, nation in all of these. But these are things that can, at any time, just thwart any growth or development. However, notwithstanding, on the domestic side, we're doing quite well. Inflation is contained. There's a strong fiscal management. Their economy is still fairly robust, even though costs are a little bit higher. But we noticed that companies were borrowing by the billions, even at higher rate, but companies were still optimistic and building out capital and expanding. Quite a few listed entities, you saw them. We saw by the financial statements published post-COVID that companies were still growing. Their revenues were growing. They were expanding. There's looking at recent newspaper, General Accident, it's a Wigton, expanding $10 billion expansion. So a lot is still happening. So our domestic space is still doing quite well, and there's opportunity. So what do I say? We are in a different space now than we were pre-2015, 2013, 2014. When interest rate was fairly high, there's a level of instability. We're just trying to find our way. We had these fiscal imbalances. But look at what happened 2014 onward. Look at the growth in our stock market for 2 years. I think it was 2014, perhaps 2015, 16. We were the best growing stock market in the globally. You see? Now, if we are now, I think, in a better stead now to see growth in the stock market. But it's still cautionary. But do we wait until we see growth? No. You have to position yourself now. The good thing is that companies are fairly stable. Prices are at their lowest that we have seen in many years, which means that there are bargain prices now. And if crises happen every 7 to 8 years, then at least potentially when we come out of this crisis, you have another perhaps 7 years of growth, given the economic stability we're now experiencing, right? So I say, come into the market. This, incrementally, average in, dollar cost averaging, they call it, right? So you keep buying, divide the investable funds, always have into perhaps quarters, and every 3 months you come in and you buy a select number of securities. Focus on strong stocks with good balance sheet, good cash flow, consistent dividend paying. So these dividends now can be reinvested in the same security or additional securities, thereby expanding the potential dividend in the next payout, dividend paying period. So these are the strategies and the tactics you can use, but do not wait until the indices move. You begin to invest now incrementally, and the horizon just have to be extended. We can't say it's a year, we can't say it's 6-7 months or a year and a half. There are a lot of developments right now around us, so these will help to determine where and how fast our economy grows or moves. However, we are in the best position now than we have been in the last perhaps 30-40 years to see growth in the stock market and to drive your wealth through buying ownership in several of these entities. So take action now.
Well, excellent advice, Clive. Thanks for your input.